I see so many people making the same mistakes over and over again. You are probably one of them, where I see so many people hitting unnecessary stop losses because they are not understanding one vital concept of trading, which is to not trust certain piece of price action based on timing. What do I mean by that? I mean that many people know the potential smart money reversal, for example, right? In which we have a sweep of liquidity, a break of structure, and then the price should reverse towards the upside, right? So people are often able to identify proper market structure, to identify liquidity above certain highs and below certain lows, right? They are able to identify a potential break in structure, a potential trend reversal, but what they fail to identify is the timing of that reversal. What do I mean by that? I am going to provide you guys with some alpha, guys, that is going to change your trading game. Listen to me very carefully. If certain pieces of price action, if certain reversals and certain market structure breaks and liquidity sweeps take place on crypto, either during the weekend, or on Forex or crypto, either during bank holidays or holidays in general, you should never ever trust this piece of price action. And the trap has a very high probability of playing out. There's a very high probability if certain reversals, market structure breaks and liquidity sweeps take place either during weekends or during holidays, that they are a trap and that you should never ever trust them. Instead, we can use them to outplay the trapped traders. What do I mean by that? So first of all, if you ever see a smart money reversal like this during a bank holiday, you should not trust it. Instead, this piece of price action over here is a trap. In a little bit, I'll show you guys two examples that we saw over the past couple of days where many traders got wrecked very hard because of these exact reasons. But first, how are we going to apply this? How are we going to utilize this to make profit? Because at the end of the day, it's nice to not hit stop losses anymore because of the timing of price action and understanding the timing of price action, but it's even better if we can use it to make extra profit. Let's say that this piece of price action over here is taking place during the weekend. Let me make this a little more detailed. Let's say we are in a downtrend and then during the weekend, price of Bitcoin starts ranging and then we see price action like this. So we see a nice little sweep of the low and then on Sunday we pump and we get a break of structure and we confirm the structural break over here. Now we know that this is a trap. Why? Because it took place during the weekend or during a holiday. Why is this a trap? Because retail traders think that this is a valid break of structure and that they should be longing the price over here, right? If they are longing, targeting higher prices, they're obviously going to place their stop loss beneath that local low that started the impulse towards the upside. So what does that mean? It means that that local low over here comes a significant liquidity pool and a significant draw on liquidity, which means two things. First off, it means that up on the right confirmations, we can start looking for shorts over here, right? Targeting this low over here. The second thing is that once we take out this low over here, we can start looking for high probability long positions up on the right confirmations and the right confluences. Why? Because we always want to enter where other people are getting stopped out. In this case, because of traps like this, once we take out certain lows and take out certain highs, we are going to enter where the majority of the market is going to get stopped out, because the majority of the market is going to trust these reversals even though that they shouldn't be trusted. That means that, let's say over here, like I said, we get a low time frame reversal. This one, if it takes place on a Monday, Tuesday, Wednesday, just a regular weekday, we can trust. Invalidation above the high, targeting this draw on liquidity. The trap traders over here will get wrecked once we take out this low. On the other hand, let's say we push to the downside, we take out that low, we find the right confirmations. For example, we have a fair value gap over here as well, where we tap into, right? And then after mitigating that fair value gap, we get the smart money reversal, a valid break of structure after a valid liquidity sweep. Now we know that we have a super high probability of getting a very strong reversal back towards the upside, and we find ourselves a high probability setup. This is all theory. Let's dive into the practice. The first example, guys, happened about a week ago. We can see that over here. We have a Saturday, we have a Sunday, right? A week ago on the 18th of August. It's today the 27th of August. What we can see over here at the top is that price engineers liquidity above this high. We sweep that high, right? And then we get a strong push to the downside, breaking structure to the downside over here. I told everyone to not short this move to the downside or the pullback towards the upside and not place their stop stop loss over here or over here. Why? Because the smart money reversal over here took place during the weekend. Why can we not trust these reversals? Because during the weekend and during holidays, smart money is not active. So how does a smart money reversal work if smart money and the institutions and the bigger players in this market are not even active? That doesn't make any fucking sense. Okay, so what happens afterwards? People that, for example, drew the premium and discount from the top to the bottom and they wanted to short back inside of the premium over here with their stop loss either above this high or above this high, and then target, for example, the bottom of this wick, right? This is a short that a lot of people took. They all got wrecked. Once we pumped over here, we took their stop losses, then we formed the reverse over here, and then we pushed it to the downside. All right, example number 1. Example number 2 took place yesterday on Monday the 26th of August. Find it. It was a bank holiday in the UK. What we can see over here is a piece of price action during the London session, right? We are downtrending, forming lower lows and lower highs. This is where it gets interesting, right? We have a big wick where there was some liquidity resting. We sweep that liquidity, we wick into it, we push up and we break structure, correct? On a 5-minute time frame. But since it was a bank holiday in the UK, smart money wasn't active while forming this piece of price action. So I told everyone not to trust this smart money reversal. Instead, I told everyone that there was liquidity resting over here. All right. Now, then in this case, we get a bit of a local break of structure over here, another local break of structure over here, lower high, and we take out the liquidity to the downside. After taking out the liquidity to the downside over here, you can see that we get a bit of a reversal and we take out some buy side liquidity over here before continuing our way to the downside. Now, by recognizing the timing of this price action, we are saving ourselves, first of all, from so many unnecessary stop losses. But second of all, we also get a new draw on liquidity, and we also find a new POI to enter potential longs and potential shorts on Bitcoin or any other asset.